All right, stocks continued their decline today. Same stories yesterday. We gapped up and then we didn't hold that gap really early. It filled it in early and then continued to the downside. So very common theme over the last couple of days. A lot of these indicators are turning that have been bearish. It's turning into what we expected that rally to be, a fake out rally. It took a couple of weeks, mainly because one of those weeks happened to be that summer week, right? The break and vacation. I think otherwise we'd have been more bearish earlier. And obviously you also had the Jackson Hole speech. It was a impetus, a catalyst for a lot of this bearishness going forward. But it changed the narrative. The shift that was, hey, the Fed's gonna, the commodities have peaked, inflation has peaked, and yields are gonna come back down because the Fed's gonna start cutting rates again. That's changed. So in fact, commodities came back down today with stocks, which has been rare for this year, but yields stayed higher, which goes to show that the markets now, especially the stock market, has really bought into this narrative change back from the Fed that, hey, we need real Fed funds rate to be positive. So I'm going to break down the implications of that, especially some of these technicals that we're seeing across the board that suggest that we're on a new bearish impulse move to the downside, that you would expect to at least reach those lows or to some degree. So I'll show you that. I'll show you what's driving the price action today, the difference, like the weird correlations and the differences from those correlations that we saw today. And then we'll take a look at our trade idea of a stock that wasn't as bad as the rest of the broad market has been and how to trade that. So let's go ahead and get started. Today is Wednesday, August the 31st, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen. Click that thumbs up icon to like our video. Comment down there on anything that stood out to you today. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out these things over here on the right. Come down to the bottom, click that heart. It opens up this tab. Hit that like button. Same thing here. Hit that thumbs up icon. Takes you to your Facebook tab. Hit that like button too. Again, the more you do that, it really helps us get our content out to all of our followers that are on those social media platforms. All right, well, let's take a look now at the S&P 500 first of all, and see what's going on today. Dark pink shading and a red line. So we are 4% below the 30-day moving average. Again, I mean that we don't get this far below the 30-day moving average on just minimal pullbacks, right? I mean, you can see if you follow my cursor along, the only times we've ever been below that is at the very end of that intermediate decline, or when we started these legs lower. And considering that we are coming off of a lower high point instead of a higher high point relative to the last intermediate peak, which is the end of March, or the last time the intermediate line went up above into bullish territory and peak there. You can tell we are in an impulse move to the downside. We have a bearish impulse move to the downside. The intermediate line has declined below its market sentiment, which is a bearish crossover. The short-term sentiment lines are below the 5th percentile. Near-term line has been down here for a long time. This is very bearish short-term sentiment that we typically don't get, right? I mean, you've got a few times over here when we started this whole thing, and it appears to be, again, that was right when we got dark pink shading and a red line right at the very beginning, and that appears to be the case again. That's the type of run we're getting with the, again, red line. I mean, that is now, it's going to be easily red because we're 4% below. It's going to be hard for it to turn back around and be green again because it's turned red. That's the thing about light pink shading and yellow line. You either bounce off of it immediately off that bullish tag, or if you keep going down, then it's a reversal. It's not a bounce, it's a reversal, and we are definitely reversing here. Looking at the NASDAQ 100, you can see that it's in bearish territory. Its intermediate line has crossed over and is in bearish territory. It's actually 5% below, and you also see too that it has the bearish crossover and the very short-term bearish short-term sentiment. And then you notice the Russell 2000, we also have the cross. We are 3.5% below, but you notice that we're not in bearish territory yet, and we don't have the red line yet. So the Russell's still holding up much better. In fact, it's still above the 38% retracement of the intermediate decline. the 38% retracement. If you look at the NASDAQ 100, it is easily below the 38% retracement, right? And it's actually getting closer to the 23. It actually dropped below the 23 of the brown move, the full year-to-date move. And the S&P 500 is also easily below the 38% green, and is now working its way towards the 23%. So the Russell's been actually holding up a lot better than what we've seen on the NASDAQ 100 and on the S&P 500. Now that the month is over with, let's take a look at what the monthly market forecast. Remember how bullish we were last month. It was such a good bullish move, and we got back above those important Fibonacci levels, the 50% one here earlier this month. But look at that month. I mean, it's a long upper shadow on a month here. The intermediate line still declining. We are still above the 30-week moving average. So we got the light pink shading yellow line, which is very rare and tends to be pretty bullish. We talked about that in June, and it turned out to be a really good bullish bounce for July, as has been the case pretty much every other time we've gotten this signal. But it's no follow through, and that's the problem, is we didn't follow through with a good bullish August. And that's kind of what we talked about in July, was we need to really follow through with that in August, and it didn't. The near term line is up. But if we come back down and get below 30-week again and stay down, 2.5% below it, then that near-term line is going to peak and come back down to bearish territory. Again, it's not too often that you get it down into bearish territory. You had it there in COVID briefly, there in that intermediate pullback, a couple intermediate declines here in 2018. The fourth quarter 2018, that first quarter 2018, there's 1516 near-term line on the monthly chart got down there, and then 2011. I mean, it takes a correction to get down there. We've had it. This is the biggest drop of the near-term line on a monthly basis into bearish territory that we've had in all these other corrections. Even COVID, like you can see on COVID, we got to 39 on this month, and then you did dip to 25 there in March. And then because we came off that low in March and because we had a good April, the near-term line was actually right back up to 59. So they only spent 2 months down there. Pretty much that's kind of the idea. Over here in 2010, it's been a little bit. You were at 54, and then you got down to 14, and then 23, and then 39, back up to 39.60. So pretty much 2 months. But then you can see back in 2008, we stayed down for quite a while, for multiple months. And that seems to be the case here. It seems to be that, like in 2008, where we had the failed correction bounce, the near-term line got up to bullish territory there after a couple good months. It looks like we were only going to get to the 60th percentile. I mean, it did get to 60. Let's see, it got to 59. So it didn't quite get to 60, but I mean, pretty much. 59.88 is about as close to 60 as you can get there. The NASDAQ 100, on its monthly, remember it's such a good bullish week, month 2 in July, almost the exact same thing. Near-term line is a little bit above 60, but we are below the 30-month moving average, pretty bearish, and we did drop significantly below. You can see, if you follow my cursor along, we never did drop below the 30-month, and even in early 2008, we didn't drop this far below the 30-month. Only over here, when things really hit the fan, did we get this far below the 30-month. So that's a pretty significant drop on the NASDAQ 100, and then your Russell 2000 is still below. Like we never did get above the 30-month. As you can see, the yellow line. We've been light pink shading in the yellow line now for multiple months, and then again long upper shadow there, and again near-term line getting in the bullish territory. But again, considering the long upper shadow, which is bearish, you would expect that if we follow through with that bearishness this next month in September, then that near-term line is going to peak here. And again, like we saw in early 2000 or May 2008, when we had the failed correction, we don't want it to peak and stay. We want it to, especially this, if we only get this much in bullish territory and only get 1 month and that far in bullish territory, then that's going to be a really, really bearish peak for the near. It would be a really bearish peak on the daily chart, much less a monthly chart. Now, granted, monthly charts take a full month to get just one period, so it's going to take a while for it to turn down, and then it's going to take a full month for it to turn down, if it turns down, and then it will take another month or two to get in the bearish territory again and stay down there. So, but I mean, you can see getting in this has been in bearish territory here during this correction a lot longer than any other correction that it's had outside of pretty much the worst of the financial crisis. So it doesn't show the depth of the decline like we had in the financial crisis, because this is hardly a bear market and it's hardly a washout phase of a bear market. But it does show the extent, like the extended duration. We've been down for quite a while. And again, you know my opinions on why I don't think this is a bear market yet. I think that we are headed towards a bear market. I don't think it's started yet. I think eventually we've had a correction and we've come off the correction low. And if this correction bounce fails, which it's looking like it's failing, then there's a higher probability that we'll eventually start a bear market. That's, you can see over here, started when it failed to get above these moving averages over here. I mean, again, you get below the 30-month, you should bounce right back above it. And the fact that we haven't been able to now for 4 months, I mean, that's a long period of time below. You can see all these other periods, we never did spend more than a month. Drop below a month, got back above. Drop below a month, got back above. Drop below a month, got back above. Remember, we were in a global bear market here that we didn't feel in the United States because the mega caps were a safe haven. These mega cap tech stocks lifted the United States stock market up where everything else was falling. Well, small caps aren't mega caps, so they weren't as much of a safe haven. They got a good lift, but they weren't as much of a safe haven, so they had a lot more times. You can see the NASDAQ, for example, never did dip below during this whole 2018 from fall of 2018 to COVID. We never did get below the 30-month moving average, but the Russell 2000 did multiple times, right? We did there in the fourth quarter 2018, jumped right back up. We did there in 19, jumped right back up. Got there in August, jumped right back up. Let's see, 2 months, right? You're almost back up. The second month, you got back up. And then here, again, it took a while to get back up, but that was because it was COVID. And the Russell 2000 took a lot longer to jump up than the NASDAQ did, right? The NASDAQ, we got below, and we never did close below the 30-month during COVID. The NASDAQ did. And again, you can see how these mega cap names were safe haven. The S&P 500 only closed 1 month below and jumped right back up in COVID. The Russell 2000 got below and stayed below because it lagged. The Russell 2000 kicked into gear right there from the election and the vaccine news up to that March peak. Is really where the Russell 2000 finally kind of kicked in gear and caught up to where the rest of the markets were doing there. Let's take a look at the other long-term chart that we always look at. We got that's a bearish candle closing below last week's low there. It's about as bearish a candle as you can get. So I mean, we got the red arrow, we got the falling, we got the bearish Hakinashi candles about as big as you can get when you don't get them that big when you're in a bullish trend. And we're still in death crossing buyer. In fact, the PPO is turning back down. You see that in the S&P. You see that even more, especially in the NASDAQ, very easily here in the NASDAQ. Very big Hakinashi differential there. And then, of course, the Russell 2000 is getting the red arrow this week with the bearish candles. So you can see the obvious turns in the S&P 5 and the markets there. Let's take a look. We've had now 4 days of pink. Remember how when you get 3 red arrow signals, it's usually a bullish signal. When you're in a bullish trend, it's a bullish signal. If you don't bounce immediately off maybe 1 or 2 days, then you're, and especially if you drop more than 2.5% below the moving average on the S&P, then you're more likely going to be bearish. And so that appears to be the case here. It appears obviously that we're not going to bounce up here, and we are, in fact, the histogram is still falling, and that's, we're still easily below 17-day moving average. But you keep in mind that the histogram can rally up, can turn up, while we still stay below the 17-day. The MACD can cross above its moving average, and we can still stay below the 17-day. So in fact, during this run, the histogram turned up 1, 2, 3 times before finally, after it turned up 3 times and the MACD crossed above its moving average, did we finally close above the 17-day. And stay there. Okay, so just because the histogram might be bottoming, that doesn't mean necessarily that we have to turn up. And now, sometimes the bottom occurs, the histogram bottom and the MACD bottom occurs at the same time, and we do bounce up pretty sharply. But even then, it takes a few days to get back above the 17 when you're that far, when the MACD is that low. MACD is not that low right now, actually. So it actually still has a pretty decent amount. It is a pretty low histogram, but the MACD itself is still actually falling, moving to the downside. We're easily below. In fact, the 8 and 17-day moving averages are just barely, the 17 just barely crossed the 30. So they haven't crossed the 50 yet. Price has crossed the 50. Now we expect that it stay, like the next stage is either it fails there and bounces back up, or it stays down long enough to bring the 8 and 17 below. So, and the expectation here, at least in my opinion, is that's the latter is going to be the situation here. Let's look at some of these other oscillators. The DMI, the positive indicator is now almost below 20. Had been so bullish for so long. Now it's almost below 20. The negative had jumped above 25 and now is up above 30. So like we've reversed course in a big way there. The RSI and the CCI have dropped to bearish levels. We were bullish, we failed there, and now we're at bearish levels. We're below 40. We got below minus 150 on that low point. Ichimoku cloud, we are still above the cloud, but the green line is now crossed below the blue. That's a bearish crossover. You can see how bearish that is when it does cross below the blue there. So that's a crossover. And you can see we have the beginnings of a weak bearish trend. And look how close we are. The red line is, for it to stay above price, the red line here, you can see right where my cursor is today's close plotted as a line chart 26 days ago, offset by 26 days. And then you can see this chart is plotted by, this chart is plotted forward 26 days, the cloud itself. So by the time we get to the cloud, if we're going to be bullish, we need to stay above the cloud when it turns green, because that's a 26-day period, right? But 26 days ago, we had a crossover that allowed this to turn bullish, that allowed this chart here to turn bullish here. So that's great. But now we need to stay there by the time we get there. You can see, like, by the time we got to the green here, because we had that crossover at the end of March, by the time we got to the green, we were well below it, and the price itself was also well below, so it had crossed below. So that's what we need to avoid in the next couple of days, and stay above this cloud, and for the red line to kind of bounce up sharply, as you can see, and stay above price there. If you take a look at the stochastic indicator, I've been sharing you too. You can see how we still maintain really bearish close within in fact, we closed at the low today, so we closed at the low of the 4-week period. Right, so pretty much right at 0.12. I guess we were right off of the low. The low was 39.54, and we closed at 39.55. So it's 0.12, but you can see now the orange line's about to cross out of bullish territory. So I mean, that's pretty bearish, especially to be down this low for this long. Multiple days being below the 10th percentile. Here's the 10th percentile right here. So it kind of gives you an idea of the extremes to the downside. It's actually the 5th percentile is the extreme, but considering this is a 4-week range, it kind of gives you an idea here of where the extremes are. So there's the extremes. You can see that we don't stay in the extreme for very long, right? We tend to bounce. When we get really low, we tend to bounce pretty quickly. Even when we're really bearish, at least it bounces up, and then comes back down, bounces up, comes back down. Well, we've been below the 10th percentile now for 4 days, 4 straight days. I don't know, like over here we had this period, we had 1, 2, 3 days, and we were back up there. Over here you had 2 days and you're back up, 2 days there and back up. So this is the first time we've gone 4 days. Over here you had over there, and then 1, 2, 3 days, and you bounced, and you had that big bullish move with a big hammer pattern there. So now we are 4. I mean, that goes to show just how bearish this past 4 days has been. How there's just been, it's been hard. From a rune indicator, remember, we don't set the low point. We got to get that. Not only do we have to get that blue line out from below the 10th percentile, but this red line's got to cross below 70 for us to set a low point. Obviously, we're still at 100 because we set the 4-week low. And then finally, if you look at your hull indicator, the chart we use for the hull, it's also very bearish. It didn't close below yesterday's low, but it did close lower. So we're still getting lower closes. It's going to be hard to turn around until you get a higher close. And even then, it doesn't turn it completely around, but at least you got to get a higher close, and before we get a bullish candle and a green hull moving average and a parabolic star flipping, and the green line here crossing back above the purple, and that's obviously not happening anytime soon. I did want to mention the McClellan oscillator. From a breadth standpoint, things have been just really bad. The breadth has been bad on the downside. So I mean, I told you we were going to drop below 500 if we stayed this bearish. Well, we did. So we are now below 4,000 easily, but we got back below 500 easily with some. I mean, this is the worst breadth at minus 91 that we've had of the year. See, that was minus 89. This has been the worst period of breadth that we've seen during this entire cycle. That's what the oscillator is telling us right now. And if you look at the on-balance volume, because I've been showing you that lately as well. If you look at the on-balance volume here, today's volume, here, let's go to SPY. Today's volume is down here at minus 980. Again, the lowest point that it got to was this 958. You can see, so it's on this day right here. It was at 958. So we closed right where my cursor is. So the volume picture right now shows that we are actually worse. It should be like if and when we do drop below that low point, the on-balance volume will have easily confirmed it because it's already down below that low point. So it goes to show, like you can see, we are down. We've recovered all the way back to about this level where my cursor is on 725. We pretty much erased everything from 725 to now. If you look at where the on-balance volume was on that day on 725, that's where it was. So we've had, during this up and down, obviously you can see we had a lot more volume to the downside than we've had to the upside, even though there's been a lot more up days than down days. But that's what the money flow down there is telling us. And so when I told you before that the money flow was not confirming the bullish move, the money flow is confirming the bearish move. So there's, we are in a new impulse move to the downside, to say the least. Let's look at and interestingly enough, the VIX still is not strongly bullish. I mean, it still hasn't closed above 100. Only a couple times all year long has it closed above 100. It still hasn't closed above 105, which is typical for just an intermediate decline, much less a correction. So which means it's the VIX 3M that just remains stubbornly high. Like, that's a pretty high level that the VIX just can't catch up to and overcome. So the VIX is still lower than the VIX 3M. That's not typical when the VIX is rising. And then I showed you too that the correlation still is not, like, the VIX correlation with the VVIX has still not gotten back up to 100. So it's positive, and it's at 50%, but that's kind of a weak positive. You can see getting above 70, 75, getting above 70 is where it typically is for most of the year. So it still has room, which means for them to both go up. So the VIX, the VIX is still in bullish mode right now. It's above its average price over these long-term levels. Sorry, I keep hitting the wrong one there. There we go. It's still above its 200-day average. It's still above the 50-day average. It's been above that 50 long enough now. The 8 days there. So like the VIX is rising. It's moving higher, and it's not peaking. It's not rolling back down to the downside. It's not continuing to move higher, but it's not. It's the storm is still here, and we haven't seen the tornado yet. Like as bad as the breadth and the volume have been this past little bit, couple weeks. As bad as this picture has been, we still haven't seen the tornado and the volatility where it just takes off to the upside. In fact, when you look at this chart, the VIX with the DMI, I mean, you've seen the VIX get a lot higher. So in other words, making much bigger. These are the tornadoes. The ADX, when it gets that high, that is the tornadoes on the VIX, and you can see we still haven't. I mean, we're above 20. But we still haven't had the tornado yet that gets the DMI up, up above 30, up above 35, where we've had the spike, where we've had the parabolic move. So that kind of goes to show, what we still, like, it's kind of like the hurricane season. We typically get, some hurricanes during this time of year, but we haven't yet. And so that's the same thing. We typically get, in this kind of picture environment, we typically get a tornado to come out of it, and we haven't yet, which means do we still need to get it, right? Do we still need to get that there, especially considering the seasonality of the VIX, spiking, like, it's still like, here's where we are in the seasonality, August 31st, where my cursor is. That's where it gets to by mid-October. So this is still a very bullish time this is still a very bullish time for volatility, even if we've already, this was a bullish time too, just to get to this level, and we've seen it playing out, and we still have, it might moderate here a little bit through September as we get towards the end of the quarter, but through the end of the quarter, beginning of the next quarter, that's a pretty sharp move. It's one of the bigger moves from a seasonal standpoint for volatility. Let's take one quick look at the volume here. Obviously a lower high, a lower low. The late drop pushed us down, and we're actually down $2 more in the after hours. We're down, quite a bit here. So, we got the late close, we got the drop. We're down to 393, just below 393 there in the after hours. So lower high, lower low. We're easily below last week's low. Very bearish from that perspective. And then, like I said, the volume has been confirming this bearishness, and we're above average again. So 76 million, and the range was just a little bit below average. So that kind of goes to show like we're not getting 75 million shares right here, is right there. And the 6 points is right here. So these are not such bearish moves that they just wash everything out, which suggests that it's really easy for it to maintain it. Now it might bounce up, right? Remember the idea here that it's rare, so don't be surprised if we don't bounce up tomorrow on this. But you can see when it does bounce up out of these bearish levels, it has to get up at above 60 for it to really change things and then stay there. And every time it hasn't, since it's been bearish, every time it hasn't come, and then when it has, it's gone up and stayed. But like that, it's really got to get up here, and that's unlikely. What do you think? Do you agree with that assessment there? Do you disagree? Let me know in the comment section below, especially if you disagree with what charts or indicators you're looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am. All right, let's take a look at our price action now for today. And you can see emerging markets actually held up pretty well. But what's interesting is commodities fell hard. And that's not typical for your risk-off narrative, right? The risk-off narrative has been, at least the year-to-date selling bearish narrative, has been higher commodities, higher yields, higher dollar. Well, the dollar was down today. Yields were up, as you'll see here in a second. But commodities were way down, way down. 2% drop for commodities. To kind of give you an idea, it doesn't sound like a lot, but let me come over here to the daily price moves and pull up DBC. That's a pretty decent sized move. It's not too common that you get that. Obviously never during a bullish market, but that's not too common. We've had two in a row, two consecutive declines. Those are pretty significant declines, especially with the two gaps that we've had. If we look at the chart for commodities, let's look at this chart right here. You can see that it is dipped back below the 50-day moving average and the 30-day moving average and the 17. So technically today closed, there's bearish divergence because you close below the 17 and the MACD closed below its moving average. That's a bearish divergence there according to this MACD chart, right? Because it's the 17 is the slowest moving average up here that we're looking at in this indicator. So you drop, so that's a bearish. So not only did you do that, but you at the same time also crossed below the 30 and the 50s. So a pretty bearish move on commodities. You wonder if this late cycle commodity run that peaked in May of, that also peaked during the correction, in May 2008 is peaking here. This at a lower high instead of the higher high that we had there. And again, when it came down from May 2008, it came down with stocks. I remember how the correlation here, when you look at the correlation of commodities to stocks here for most of the year has been bearish, right? So here's zero. So there's, here, let me give you some perspective on this. Let me zoom out a little bit. So for most of the year, the correlation has been bearish, and that's not been the case going, for most of this time. It's actually been bullish for most of the time. Here, let me change this to SPY. SPY. So there we are, below zero, like negative. But and that was the case too. Go back here. Let's go back out 2008. So here's 2008, 2009. You can see it was also negative in early 2008 during that correction. And then there was the failed bounce, right? This was the failed bounce in May up to the failed correction bounce. And eventually got positive again. Well, so, you wonder if that's the case here where, it had positive, it turned back down, and now it's going to turn positive again with both commodities and stocks dropping. Especially considering that even though commodities are down today, yields were not. Yields actually went up to 3.13%. That's a pretty decent move. That's the highest close we've had in commodities here. It's still moving to the upside, and the dollar is still holding up at these high levels too. It's not breaking down, even if it were in kind of convergence mode. We're about to be in convergence mode, where you're below the moving average and you're above the 17-day moving average there. So that's the idea behind, and you can see the we are below average on the volume. The dollar is really, really below average, but they're holding up even with commodities falling. So it's of the three things that's been driving this bearish narrative all year. One of them is the commodities is the only one, and you wonder if the commodities are breaking down, like they're turning positive in their correlation with equities in terms of a risk asset class. Remember, it's a lagging asset class. If you look at this chart here, the weekly chart, bonds are the leading asset class, right? So bonds go down. The dollar had already gone down. All right, see, the dollar was in its bear market going into 2021. So the dollar in 2020 and the 2021 was in its bear market. TLT has been in its bear market right now. So the dollar and then bonds. And then equities start to head towards their bear market, and of course you can see we're still above the 200 week, but below the 30 and the 50. And commodities are barely above. We're still easily above a rising 50, way above the 200. So this would be last. And again, you can see back in 2008 when eventually you crossed. We were also way up above when the market was failing. And then it rolled down to the downside along with equities. So that's when it really dropped. And so are we facing a very similar pattern? There's not any volume here. We went so far so fast in early 2022 that it can drop pretty hard too. And if it does, I know a lot of people are thinking, well, that would be really bullish. Well, again, there's only two reasons why it can drop sharply. Either we get a dramatic increase in production, or, and I'm not talking about like what might drive that production or anything. I'm just talking about just generalities. You either get a dramatic increase in supply that outstrips the current strong demand, or you get a dramatic drop in demand that relative to the current supply. And if you had to choose between which one of those two, for it to drop all the way back down here to say like 19, then you would expect that would be a dramatic drop in demand. With the current supply, because it doesn't look like we're getting a dramatic increase in supply anytime soon. So that kind of gives you an idea of what, from a macro perspective, what might be driving a lot of the bearishness here. Let's take a look at the sector rotation. So bear with me 1 second while I bring up the comparison chart here. And again, just looking at today alone. And you can see that we were pretty dramatic to the downside. Energy and bonds, industrials, financials. That's that reopening trade all really down. In fact, XLC was the only stock sector that was positive. Real estate eventually was trying to be positive by the end of the day. It dropped. Utilities and staples are positive early, along with energy. They all dropped. That's pretty broad. And now, granted, it wasn't like a big, huge sell-off. But it's pretty broad in what sold off. They all sold off to pretty much the same degree. And remember, when things get bearish, everything gets bearish. It's not just some things here and some things there. You can see we're already starting to get dark pink shading and red lines in 3 sectors. You got dark pink shading and yellow line in 4 more sectors. You got a yellow line and light pink shading in 2 more sectors. or 3 more sectors, and then you still only got one, which is energy, that's got the dark green shading. So if everything starts dropping, then it goes to show just how bearish we are. All right, now let's take a look at our trade idea today, and I want to look at Wells Fargo. Wells Fargo has been pulling back. It was down today, but it's not dropping dramatically. The instant market sentiment line still actually, or intermediate line still barely below 60. So it's easily still above 50. It's no dark pink shading. It's still got a yellow line, and it was just barely below. We're only 1%, so we're not extending below the 30-day moving average here. When you look at its long-term chart here, the weekly chart, it's been bearish, but no red arrow, right? And it's barely we're not closing below that low point there. So it's hardly like a strong bearish turnaround. When you look at the 3 red arrows, we do have 3 red arrows, but like I said, it's not. And it's been a few days, but it's not like sharply below. And we got a lot of volume here today, and we didn't close below those lows. And it goes to show there's a pretty decent battle in a small range. When you look at some of these other oscillators, we're not bullish anymore, but we're not really bearish. The bearish indicator is still down. When you look at the RSI and the CCI, they're still kind of in neutral levels. Looking at the Ichimoku cloud, we are above the cloud, and we don't have a strong bullish trend going anymore, but we also don't have a bearish trend going at all. And we are easily, remember how I said how important it was to stay above the green? We are easily above the green here. Easily above the green, and the price, the red lines, it got a much easier chance of staying above price than like the S&P. Remember how the S&P has to like really dramatically rise here over the next few days to avoid a crossover. That's not the case for Wells Fargo. It can easily stay up here and rise up, and so not so bad, not so bullish, but not so bearish either. And of course, that generally means I like to do an iron condor, and that's what we did. We sold. Now, because I'm not so bullish, because the broader market's not too bullish, I was able to be a little bit more aggressive on the upside. So selling the 45s right around, it was a 44 delta at the Market Outlook Live, but we sold that and bought the 47.5, sold the 37.5, bought the 35. So there's the trade, and then you can see our break-even levels right here. So as long as we hold that old low point in June, we're fine. And if we do stay bullish, if we don't jump up to such strong levels here, we'll be fine too. So going into October expiration, right? Because we're almost there into September expiration. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums where you can open up any new thread there, reply to anybody else's thread, and let's keep this conversation going in between videos. Thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to us on MarketScholars.com for free, as I mentioned earlier. Like us on Twitter and Facebook. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.